I'd like to talk a little bit about the types of projects that you're going to be looking at. When you analyze a project, you want it to be an independent project. You want it to be able to stand alone. You want to make sure that you have taken into account any impacts that this project is going to have on other parts of the company. So if you have a project where if you do this project you need to build a new warehouse, that is not an independent project. You have to include the impact of building a new warehouse when you're analyzing that project cash flows. Next, you may run into mutually exclusive projects. These are either-or projects. I need to get across a river. I can either build a bridge or buy a boat. Either-or. Mutually exclusive projects are also independent projects, but in the case of mutually exclusive projects, you can only choose one and not both, even if they're both good projects. Project sequencing. This is becoming more and more of an issue. Very often, you will have a project, and if you successfully complete this project, you can do more of it. There are growth options built into the project. We complete phase 1, that opens us up to phases 2, 3, and 4, and however many projects we have. What is happening in the field of finance is that people are saying, hey, you know, this discounted cash flow method that we've been using, which is great when we've got a set of cash flows, one set of cash flows, doesn't work so well when there's project sequencing. And more people are saying, let's look at options theory, let's look at real options, because doing one project gives us the option to take on a new project. And this is an area that is getting applied more and more to capital budgeting. And then finally, capital rationing. Finance theory assumes if you have a good positive net present value project, no problem getting all the money that you need for that project. Well, that's a lovely theory. That's not true in reality. A majority of firms are capital rationed. They can't accept all the good projects that they have because they just can't get the financing for those projects. So we'll look at techniques to use when a company faces capital rationing, when it doesn't have enough money to handle all of the projects that it would really like to do. Next, I'm going to talk about capital budgeting criteria. I'm going to talk about the methods that you can use to determine whether a project is a good project or a bad project, whether or not the company should accept that project. The first method that I'm going to talk about is payback. The payback method says, let's look at the cash flows that you can get from a project and see how many years it takes before you recover that initial investment. So let's take a project where you pay $5,000 in order to do the project. So you have a year 0 outflow of $5,000. Then in year 1, you get $1,000. In year 2, $2,000. In year 3, $3,000. And in year 4, $4,000. Let's look at the cumulative cash flow. At the end of year 0, I've spent $5,000. At the end of year 1, I've made $1,000, so my cumulative cash flow is negative $4,000. At the end of year 2, I've made another $2,000, so negative $4,000 plus $2,000 is negative $2,000. At the end of year 3, I've made another $3,000, so my cumulative cash flow is negative $2,000 plus $3,000 or plus $1,000. What that says is this project is going to pay back somewhere between years 2 and year 3. I will have fully recovered that $5,000 by the time I've completed year 3. Well, if we want to be a little bit more exact than that, we can calculate an exact payback period. We had a $3,000 cash flow occurring in year 3. We had negative $2,000 in cumulative cash flow up to that point. Well, we would get the first $1,000 in the first third of the year, the second $1,000 in the second third of the year. So the payback for this particular project is 2.67 years, 2 2/3 years. So this project will pay back after 2 years and 2/3 of a year have gone by. The problem with payback method, it's considered universally to be a very bad method, a very bad way of choosing projects. The problems with it are, first, it doesn't include the time value of money. You're just adding up those cash flows. You are not taking the timeline into account. No time value of money in that method. The next thing that's really bad about payback is that it ignores all of the cash flows that occur after the payback period. In the example that I gave, you're ignoring all of the cash flows after 2.67 years. You could have very significant cash flows occurring after that time period. So 2 really significant problems with payback. Just about the only good thing I can say about payback is that it's easy. If you want to teach someone how to do payback, you can teach them how to do it in a couple of minutes. But again, as a capital budgeting criterion, it is a bad choice and should not be used. My faith in people's capital budgeting was a little bit restored. There was a fairly recent study, about 2000, that came out about payback. And I had some sympathy for people who use the payback method. If a company does face capital rationing, and most companies do face capital rationing, they might want to get money back early so they can reinvest it in the other good projects that they haven't been able to invest in because of lack of money. I had sympathy for that until I saw this survey. They did a survey of chief financial officers and chief executive officers, and what they found out is that payback was most used by CEOs and CFOs who were older and who did not have an MBA. So the conclusion of this study is that this method was used by less sophisticated capital budgeters, and that those who had more education were recognizing that payback was not a good method. Now, in spite of that, it's important that most practitioners know payback. In spite of all of the disadvantages of payback, it is still, today, the most popular secondary criterion, not the major one, but a secondary criterion. So you still may be running into payback. Now, the next method that I'd like to talk about is called discounted payback. The proponents of discounted payback say, okay, we recognize that payback doesn't take into account the time value of money, so let's look at discounted payback. Let's take the time value of money into account. And in this particular example, I'm going to use the same cash flows, but assume that there's a 12% discount rate. So we've got the same cash flows. This is a project that's going to cost $5,000 initially. You're going to get $1,000 in year 1, $2,000 in year 2, $3,000 in year 3, and $4,000 in year 4. Let's discount each of those cash flows. Let's take the $1,000 and discount it back one period at 12%. So 1,000 divided by 1.12 is $893. $2,000 divided by 1.12 squared, discounting back 2 periods, is $1,594. $3,000 discounted back 3 periods, so 3,000 divided by 1.12 cubed is 2,135, and 4,000 discounted back 4 periods, 4,000 divided by 1.12 to the 4th power is $2,542. Well, now let's look at the cumulative cash flows. Negative 5,000 in year 0, add $893, so we're at negative 4,107. Add $1,594, we're at negative $2,513. Add $2,135, we're at negative $378. Add $2,542, we're finally positive at positive $2,164. So payback occurs between year 3 and year 4, and actually pretty soon after the beginning of year 3, you will achieve discounted payback.